Looking for strategies to help you protect your portfolio in these uncertain times? Visit robblack.com. robblack.com, powered by EP Wealth.
I'm extending my 4th of July vacation for a couple of days at the start of this week. I'll be back early to midweek. Thanks for listening to the show. Don't forget you can always sign up for events at robblackshow.com. Staying disciplined is a lot more important than conviction. I've written down many rules through the years that help explain my thought processes for myself. One of them is the dividend doesn't lie, but the story can. A CEO or an analyst can paint a beautiful picture of future growth during an earnings call, but talk is free. A company that consistently increases its cold, hard cash dividend payouts year after year, it's delivering real proof of financial health. Follow the cash flow, not the corporate PR hype. Another rule is you don't own a ticker symbol. You own a fractional piece of a real business. A lot of people that I run into seem to get the two confused. They own too many ticker symbols. They don't think of it as owning a business. When people treat stocks like a flashing green and red number on a smartphone app, they panic during normal volatility. Remember that your shares represent a physical piece of warehouses, intellectual property, phones, real-world consumer demand. If the underlying business is thriving, ignore the daily scoreboard noise. Buy great companies. Oftentimes I tell my kids, we own Apple, so we're going to go into an Apple store. We're not going to get the phone through Verizon. We're going to see what it's all about so you can see the business. Hope is not an investment strategy. It's a great rule to live by, maybe even get a tattoo of. The moment you find yourself saying, I just hope the stock gets back to what I paid for it so I can break even, your thesis is officially dead. The market doesn't know what price you bought it at, and it doesn't care about your feelings. Cut the dead weight and reallocate that cash to a sector leader that's actually moving upward. Sometimes on radio, I'll say hope belongs in two places: the football field and the church. The football field is I hope the San Francisco 49ers go to the Super Bowl because it'll make everyone around me pretty happy. I hope when I die, I go to heaven because that would be a nice thing versus the other alternatives. Another rule that I live by is your money market account is your strategic bunker. Never feel guilty about holding a healthy bucket of cash. When the market gets frothy, cash isn't dead money, it's tactical ammunition. Having a safe liquid reserve yielding stable interest allows you to sleep peacefully at night and lets you strike aggressively when high quality stocks go on sale. Wall Street sells retail investors what they want to buy, not what they should buy. Keep that in mind when you pay attention to CNBC. Brokers and analysts love creating highly complex, speculative, thematic funds right at the peak of a trend because hype sells tickets. I don't believe in using pro shares with options. You know, the ones that get like 3 times the market return. Again, if you're going to be very short term, it's fine. But if you're doing it long term, it's a mistake. The options are expensive. Many of them expire, same thing, worthless. You got to be really, really careful on some of the things that you see, the pro shares. Ooh, I want 3 times the Nasdaq's return. If Rob says the Nasdaq's going to go up 15 to 20%, I want 60%. That's not the way to play it, especially not with options. Stick to boring, solid, normal structures. Don't marry a stock. It's never going to love you back. This is a tough one for many people. Falling in love with a company's brand or product can completely blind you to deteriorating financials. Just because you use their phone or you love their coffee or their semiconductor helped powered you to your first million. Keep your relationship with your portfolio strictly transactional. I look at my shares of Apple, Microsoft, and NVIDIA as sources of income, as wealth. In the end, if I die with 0 shares of Apple, I'm probably okay with that. I wouldn't mind leaving some amount to my children. just to say this is something that, got us further in life because I was, how shall we say, loyal to it. Another good rule is a low stock price does not mean a stock is cheap. People look at a stock that has dropped from 100 down to 5 and think, wow, what a bargain. But a cheap stock price usually reflects a fundamentally broken business model. A $400 share price can actually be vastly cheaper relative to its massive earnings than a $4 stock on the verge of bankruptcy. I'm not all that enamored with cheap stocks. Next up, a good rule to think about is if a business model takes more than 2 sentences to explain, walk away. If a company relies on a confusing jargon, complex offshore structures, or buzzwords to explain how they actually generate free cash flow, it's a red flag. If you cannot clearly explain how the company makes money to a teenager, you shouldn't be risking your life savings in it. It's like an old Peter Lynch rule, and that one doesn't bother me. I'm with it. Next rule, market corrections are the tax you pay for long-term historical returns. It comes with the territory. You can't get the double-digit historical compounding of the stock market without enduring the occasional 10 to 20% pullback. Volatility is not a malfunction. It is a core feature of Wall Street and the system. If you want zero volatility, stick to a money market, but don't expect equity growth. Another rule that I live by is turn off the financial doomsday entertainment channel. When you see people, and there's plenty of them, there's a guy named Dr. Doom. I mean, how much gloomier can you get than that? He'll come on TV on occasion, and he'll scare people. And there was that guy named Harry Dent who wrote just crap books. Awful, not good. Poorly written, poorly thought out. But he wrote about how the market's going to crash. And it's going to be monumental, get out. He wrote a book about how the market's going to roar. It's going to be monumental, stay in. The guy sells books. Turn off the financial doomsday. They've predicted 50 out of the last 2 recessions. Tune out the constant screaming. Stop checking your balances 3 times a day and let your diversified growth assets do their job in peace. Pay attention to guidance, not just the beat. This is a great rule. We don't care on Wall Street that a company beat earnings expectations. We care about what they say about future expectations. And that's what we often circle back to of past performance is not indicative of future returns. A company can beat their past quarterly earnings by a mile, but if management warns the upcoming quarters look soft, the stock's going to get hammered. The stock market is a forward-looking discounting mechanism. It cares infinitely more about where the puck is going versus where it just was. It's tough to stay involved with, but I want you to. Another rule is the trend is your friend until the bend at the end. Riding a strong wave, upward macro wave, like the semiconductor or cloud computing expansion or AI, it's how real wealth is compounded. Enjoy the ride, stay invested, but keep your trailing stops tight, and don't get greedy when the fundamentals start to curve downward. High margins hide a multitude of operational sins. When a sector leader boasts massive gross and operating margins, they have a massive buffer to wealthier economic storms or managerial mistakes. A low margin business has zero margin for error. One hiccup in the supply chain or a tiny drop in consumer spending can instantly push them into the red. I tend not to like grocery stocks for that reason. It's just, there's not a lot of margins. And again, with Whole Foods, there's more margins. But with investing in a Safeway or investing in a Kroger's or an Albertson, not a lot of wiggle room for mistakes. Also, I want to end with my final rule is never use margin to chase momentum. Trading on margin to juicy returns during a hot streak feels great until the tide turns. A single bad week can trigger a margin call, forcing you to liquidate your favorite long-term holding at the absolute worst possible time. Keep your leverage out of the market. You can always find me online at Rob Black Show, Twitter, Rob Black Show, YouTube, Rob Black Show. Drop me an email, rob@robblack.com. I've always got events coming up. Sign up today at robblackshow.com. That's robblackshow.com.
Saturday, July 18th, join Rob Black in Sunnyvale for Pints and Portfolios, a less formal event at a local watering hole for those close to retirement with $500,000 or more in investable assets. Drop by from 11:30 to 1 for a little sunshine and a complimentary preliminary plan from a CFP that Rob trusts at EP Wealth Advisors. Whether you're on the road to retirement or already there, this financial snapshot can provide you with a second opinion analysis of where you are and highlight areas for improvement and opportunities for growth. Go to robblackshow.com and click the Events tab. Find Pints and Portfolios and click to register. You'll answer a few simple questions about your situation, and your confirmation email will provide all the details on the location of this Sunnyvale event and how to schedule your preliminary financial plan. Space is limited and registration is required, so go to robblackshow.com today. Investments not FDIC insured. Past performance does not guarantee future results. Not an offer to sell or a solicitation to buy any security. Member FINRA SIPC.
Many of the stocks that I own have certain characteristics that you should look for, in my opinion. Platforms with high user counts, daily active users, monthly active users, registered total users. Names like Facebook, 3.2 billion monthly active users. YouTube, owned by Alphabet, 2.5 billion monthly average. WhatsApp, 2 billion users, owned by Meta. Instagram, also owned by Meta, 2 billion monthly active users. TikTok, owned by ByteDance, 1 billion plus. WeChat, 1.3 billion plus. You get the idea. LinkedIn has 930 million subscribers. From Microsoft. Reddit, 430 million monthly active users. Twitch, which is owned by Amazon, 140 million plus monthly active users. Zoom Video, 300 million plus daily meeting participants. There's a lot of opportunity when you have that many people on your platform. Now, you marry that concept with a lot of people, you can throw in Spotify for sure. So when you marry that concept with a total addressable market, what is a total addressable market? I talk about it often. It estimates the total annual revenue opportunity if a company captured 100% of the market for a product or service. This is where I start looking for companies. Huge total addressable markets. But then you have to find companies in them. Not so hard. But then you have to figure out that company and what they can get of the SAM or the SOM. The SAM is the portion you can serve with current products in those regions. The SOM is the share you can realistically win in a defined time frame. You blend all of this together, you start looking at average revenue per user, and you start finding some really attractive ideas. For instance, let's stick with cell phones for a second. And this is why I like Apple. Also, Google. They play in this area as well. Smartphones, global smartphone market revenue is about 485 billion in the US. That market projections vary by source, of course, but about 485 billion for the year 2025 is what I last saw. Social media, the global social media market, when you add in advertising, platform services, and commerce, it's about 185 billion in 2024, with forecasts into the low to mid hundreds of billions in the next few years. Music streaming, global music streaming market of about 46 to 47 billion in the US. Industry reports show strong compounded annual growth rate ahead. Video streaming. Global subscriptions for video streaming market is roughly $119 billion at this point in time. So you can see the areas that I'm very attracted to. Now there's more. Artificial intelligence and AI infrastructure. Total addressable market of $500 billion to $1 trillion today, and that number seems to keep growing on a quarterly basis. Cloud infrastructure and platform services. They do compute, they do storage, managed services, enterprise software as a service. They do developer tooling. Cloud infrastructure and platform services, about $800 billion. Digital advertising, when you combine search plus display plus social and into connected televisions, you're talking about $450 billion. Mobile apps for in-app purchases and subscriptions, $350 billion. Now, some of these companies like Apple, they get a cut of that mobile app. Do you see how some of these big total addressable markets do crossovers? And when you have the daily active users and the monthly active users, it's pretty powerful. And Apple's hardware, for instance, opens the door for them to do software and services. which we just talked about, is a huge market. Global e-commerce, which is goods plus marketplace services, about $4 trillion. Gross merchandise value, that's pretty impressive. Video streaming, which is subscriptions plus advertising plus premium rentals, $200 billion plus dollars. Again, many of these areas kind of cross into each other. Some huge total addressable markets I don't talk about very often: life insurance, health insurance, $5 trillion plus dollars in gross written premiums globally. Banking and wealth management and asset management, why you want to own someone like a Goldman Sachs, a Morgan Stanley, a Capital One. Citi's a great name. It's $1 trillion plus dollar market for the services tied towards banking. Advisory management fees, custody, lending interest margin, payments. The global payments market, when you start looking at it, it's about $500 billion plus. And that's why I own companies like Visa. And that's why some people are interested in companies like PayPal. Healthcare services and digital health providers, devices, telehealth, pharmaceutical services, $1.5 trillion. Renewable power and energy storage, $1 trillion plus dollars. I don't play with small business models. Electric vehicles and charging and software, $1 trillion plus dollars. Huge total addressable market. Logistics, freight, and last mile delivery, $1 trillion plus dollars. That's why you have to like a company like an Uber, like a company like a DoorDash, and the services that they provide. Now, you got to treat headline total addressable market as directional, not as a forecast of revenue. You got to break it down to what can a company reasonably serve. The robotaxi industry, is it going to be winner take all? No. There's going to be Waymo robotaxis and numerous others, including maybe Tesla. And again, Tesla's got the EVs, but now they're in the robo-taxis. 2 total addressable markets can show you the potential. Some of the names that I like that have a total addressable market of at least $10 billion include Apple, Microsoft, Google, Amazon, NVIDIA, Meta, Visa, MasterCard, Oracle, Pfizer, Disney. Again, some of these names I like Pfizer and Disney, but I don't necessarily own, but I do own them in S&P 500 funds. Netflix, we've talked about that already. And I own it because of that total addressable market plus the monthly active users, the daily active users, the hours of TV that we watch per day. Dominated now, not by ABC, NBC, or CBS, not by Fox, but by Netflix and by YouTube. My kids don't know what network television is. I don't think they watch one show on network television. They might watch some clips on some of their platforms that they're watching, whether it be YouTube or TikTok. They don't do a lot of Instagram. I think that's an old person thing, if that makes sense. So when you start looking at a company platform in a little bit more detail, Facebook, they've got 3 billion plus monthly active users. They have digital advertising of greater than $200 billion. You look at YouTube, 2 billion plus monthly active users, digital video advertising and streaming ads of over $100 billion. TikTok has 1 billion plus monthly active users, short form video ads and commerce. If that company ever gets to be put into a publicly traded company, I'm definitely going to be looking at it. Or I'm going to use my trick of it's got daily active users. Yes. It's got monthly active users. Yes. It's got a total addressable market that's huge. Yes. And if the stock were to ever fall 10, 20, 30% for whatever reason, it could be a stock market pullback. It could be a bear market. It could be the CEO resigns in a scandal. But other names on my list include Spotify, 500 million plus users, Netflix, 300 million plus users, Amazon Prime, 200 million plus users. Anyhow, I've now given you some insight into my thinking and why I do it. I don't know why you pick the stocks you do. Hopefully you have a good reason. Total addressable market, how much can they serve, as well as how many monthly active users. Those are 2 of the most important ones for me. I always have events coming up. Sign up at robblackshow.com.
What's the best way to choose a financial advisor? Download our guide at robblack.com. That's robblack.com. Powered by EP Wealth.
It's about time that I do a segment for teenagers and people under 30 as they transition from teen years into being people under 30. I invested when I was 18 years old after I got rear-ended in a car accident. To say that I've been addicted ever since is true. When I enrolled in my first 401k, I felt like that was a better day than, say, my marriage, my wedding day. Today, teens are way ahead of where I was. As parents, I want you to teach them stop and avoid the get-rich-quick schemes. According to recent data from Charles Schwab, 7 in 10 teenagers between the ages of 13 and 17 say they're very or extremely interested in investing. I've got 2 kids in that age bracket. One is, one isn't. So for parents, we love it when we see our kids are into this and they're thinking about money and investing. I got to be honest and say I didn't do crazy stuff like give my kids credit cards and make them sign when they're 8, 9, 10. But both my kids have credit cards now, and I showed them their bills. It's tied to my account, so they can't mess things up for themselves. Teens are growing up in an environment where information on investing is everywhere, but it's not necessarily trustworthy. There's a lot of messaging out there that focuses on get-rich-quick approaches instead of long-term outcomes. We've also seen a lot of the blurring of the lines between investing and gambling. My youngest son has the most ridiculous phrase in the world. He goes, "Dad, it's not gambling, it's winning." So the moment is ripe right now. There's a lot of information. There's a lot of fun things. Stocks are at all-time highs more often than not. There's investing in AI. There's investing in robots. There's investing in AI data centers. There's so many themes out there that can get kids excited. Back when I was younger, I was investing in Nike or maybe investing in NVIDIA if you liked video games. Maybe Disney if you have a child who loves the Disney princesses. This is a good time to teach them. Half of teenagers surveyed believe investing requires more skill than luck to make money. Although roughly the same number says investing is a good way to have fun. Parents should frame investing as long-term wealth creation, long-term wealth building, rather than entertainment. On a regular basis, my son rolls into his room and my office is close by. He goes, "Dad, stocks were up today." I'm like, "Yeah." "Dad, stocks were down today. You okay?" I'm like, "I'm okay. I buy great companies, son, and I buy more of them when they're down." The biggest risk for teen investors right now isn't TikTok influencers. It's that they're being introduced to investing through the most exciting parts of the market. Meme stocks, crypto, AI plays, options. Those are all bad entry points. I'd rather you teach them to buy great companies. So whether you're in your 20s, okay, so our teen kids are going to become 20-something. They're going to go to college. And they're going to have to start thinking about choosing a career, paying their own bills, getting their own place, living and perhaps making decisions about marriage and family. So I read into an article many years ago called 10 Financial Commandments for Your 20s so that you can get into your 30s in a better position. In your 20s, the first commandment is to get where you want to go in life. You need goals and you need a plan to reach them. Having neither is like driving a car without a steering wheel with your eyes closed. You need to ask yourself, what do you want in your future? Think about the short term, 5 years or less. Medium term is 5 to 10 years. Long term is 20 plus years. Now you're driving with your eyes wide open. Then take hold of the steering wheel to reach your goals. Budgeting is a great way to do this. I didn't like budgeting. It wasn't fun. And typically, after I hit 21, I was living with girlfriends. I did that a lot. For some reason, there was this live with. And budgeting was stressful. Because that's also the age when I'm probably doing most of my drinking, and she was probably doing most of her drinking. And sometimes you go, what's our clothes budget? What's our car budget? What's our house budget? How much rent should you pay? How much rent should I pay? We should save for a house. Budgeting's humbling. I tell 20-somethings, live within your means. Can't afford something, don't buy it. Sounds pretty simple. But too many people have a heck of a time following that one. Make savings a habit. In my 20s, when I was a teenager, I was involved in a car accident, and I got a small settlement. It was about $3,000. And I guess I got my car paid for. I got rear-ended pretty hard. If I can go back in time, I would not, because it got me into investing. But if I can go back in time to make my back a little bit healthier, I would. So I got into a thing where $166 a month would go into a Robertson Stevens tech fund. Automatically, $2,000 a year into my IRA. So if my budget for the year was $12,000 for rent, it was also $2,000 for investing. I made it a habit. I didn't buy a cold beer. I didn't go on a vacation until I paid my rent and did my investing. Your first savings priority is to amass an emergency fund. If you have a job that if you lose, it's tough to replace. I was working a lot of waiting tables and driving as I was paying for my college and going through college. So for me, it wasn't that much of a need emergency fund. I needed a vacation fund, but still was a bucket in my head of this one is for this one is for that. I started paying off my credit cards in my 20s. I got out of college with some credit card debt. I'm ashamed to say it. I don't think I bought anything of note, maybe a book here or there. That was great. But it was also a lot of paying for pizzas for friends and paying for dates. You should pay off all your credit card debt before you turn 30, and you should have other financial responsibilities to attend to. A $2,000 balance at 18% on a credit card interest would take you nearly 10 years if you pay off just the minimum 4% payment each month. That's ridiculous. In your 20s, you want to start investing. And again, it can be as small, you can use Acorns. Acorns is an app. It can be $20 a month. I just want you to start socking away maybe $200 a month at age 25, earning an average 8% of the S&P 500 plus dividends. By the time you turn 65, a Roth IRA, a Roth 401k is a great place to start. In your 20s, you want to establish credit. In order to qualify for the best interest rates on a credit card, auto loan, or mortgage, you need to start building a solid credit history. A good credit history can save you a bundle on your auto insurance. It can help you land an apartment or a job. Sometimes employers will take a look at your credit rating and see, oh, he doesn't pay his bills on time. We're not going to hire him. Have a marketable skill in your 20s. If you've come out of college and you got a history degree and suddenly you're working in retail at the Gap folding shirts, you messed up. Your own earning power is rooted in your education, your job skills. It's the most valuable asset you'll ever own. Your 20s is the time to invest in yourself and to acquire those skills. I've got a friend whose kid in his junior year took a statistics class at community college. And then he took an online class on history. And when he applied for college, those things helped. Invest in yourself, even in your high school days. It shows he's a go-getter. And as a parent, I couldn't be proud of that person in large part because he is a go-getter. So have a marketable skill. And if you find yourself in this situation where you're not happy and you're like a gig driver and you went to college, start thinking about what you can do now. If that were me, I'd be like, can I be a plumber? Can I be an electrician? Where's there a secure job that I know I can fall into and grow with? A marketable skill does not have to be a college degree. In your 20s, cut the financial umbilical cord. You have your own apartment and your own paycheck, and you even have your own spouse and children, maybe. Isn't it time you grew up? If mom and dad are still preparing your taxes or balancing your checkbook or helping you with your investments, consider maybe this is the time to start thinking, maybe I can do some of this. Not all of it, but some of it on my own. You may reach a point in your life when you don't want your parents to know the intricate details of your finances. So start now so you can cut that umbilical financial cord. In your 20s, marry wisely. I can't tell you how many people I've run into in my career that they married poorly in their 20s. And sometimes the guy took their money. Sometimes they spent too much money together. Sometimes they didn't really like each other. Money can drive a wedge between even the strongest of couples, so choose a spouse with whom you can keep communication open. My spouse asked me in therapy once, maybe it was the therapist who asked me, what's your love language? And I said, mine? Communication. I'm out of the relationship if I can't communicate with the person I love. And if they don't want to hear me for whatever reason, I'm out. Divorce is costly in your 20s, and it can even derail the best laid financial plan before that. And here's my final thought on the 10 commandments for your 20s is have some fun. Personal finance doesn't have to be boring. You just came out of your teenage years, which were all fun. And your college years should have had some fun. But by the time you hit 29, almost 30, it's going to start changing. You're going to start thinking about kids and mortgage payments and how long do you want to be at this crappy job? Have some fun. Take the time to travel and have new experiences before you have a couple of cranky kids in tow. It's not only cheaper, but it's also a lot easier. Consider a semester abroad in college in your 20s. I did. I would say I did 3 semesters abroad, which means summer vacations. Take a class just for fun or take advantage of cheap travel options like youth hostels, camping, and off-season travel deals. One of the best things that I'm looking forward to in retirement is I do not want to go to the major cities of the world during the summer when everyone else in America is going to the same cities. I want to go off-season. Build some memories in your 20s. Meet new people. Try new things. Do not go into debt to do it. Save up ahead of time and you'll be in prime position to make the most of your 30s. If you have any questions or your kids have any questions, I can send them this list. Drop me an email, rob@robblack.com. If I can go back knowing what I know today into my 20s, holy mackerel. And I'm not just talking about inside information like, oh, this team won the World Series and this was a great investment. Just, you're going to make some mistakes, and that's okay. And I appreciate you doing it. Thanks for listening. I'm Rob Black.
Saturday, July 18th, join Rob Black in Sunnyvale for Pints and Portfolios, a less formal event at a local watering hole for those close to retirement with $500,000 or more in investable assets. Drop by from 11:30 to 1 for a little sunshine and a complimentary preliminary plan from a CFP that Rob trusts at EP Wealth Advisors. Whether you're on the road to retirement or already there, this financial snapshot can provide you with a second opinion analysis of where you are and highlight areas for improvement and opportunities for growth. Go to robblackshow.com and click the Events tab. Find Pints and Portfolios and click to register. You'll answer a few simple questions about your situation, and your confirmation email will provide all the details on the location of this Sunnyvale event and how to schedule your preliminary financial plan. Space is limited and registration is required, so go to robblackshow.com today. Investments not FDIC insured. Past performance does not guarantee future results. Not an offer to sell or a solicitation to buy any security. Member FINRA SIPC.
I got into investing early, about 18 or 19 years old, and I've done a pretty good job. My motivation was to not work until the day I die because I saw my dad do that. And ultimately, it doesn't sound attractive to work till the day you die. The problem is, I think as I grew older, I learned that I wasn't really investing so I could retire early. I was investing so that I could retire with a healthy lifestyle as well as money to fund that lifestyle. The average retired worker's Social Security benefit in the United States is roughly $2,000 a month for $24,000 a year. It replaces only a portion of pre-retirement income. A lot of Americans are behind. According to surveys, roughly 2/3 of Americans say they are behind on retirement savings, and only a minority use professional financial advice. And yet the proof is that if you do use professional financial advice like a certified financial planner, you actually perform better on a compounded annual growth rate over time. A large share of working age Americans have no retirement savings at all. Tens of millions with zero saved for retirement. It's going to be ugly. I used to say you're going to be eating beanie weenies or Spam in retirement. I haven't said that in years. Consumer debt is a major drag. Over $1 trillion in credit card debt has been reported in recent years. Surveys find a substantial share of adults have more credit card debt than retirement savings. Healthcare and long-term care are expensive. A lot of retirees underestimate out-of-pocket healthcare needs and long-term care costs. They can deplete your savings rapidly, and they're a leading cause of retirement shortfalls. For instance, Fidelity is saying that 2025 estimates a healthy 65-year-old retiring in 2025 could expect to spend about $172,000 on healthcare and medical expenses over retirement. There's something called age banding, and what this is, when you look at the numbers, you're going to be spending about $8,000 to $12,000 a year at age 60 on your healthcare, roughly $1,300 a month. But when you jump up to 65 years old, it's $10,000 to $16,000 a year. $10,000 on the low end, $16,000 on the unhealthy end. Do you see why keeping your health is important? By age 70, you're spending over $22,000 a year. 71, $23,000 a year. 72, $25,000 a year. And that age banding is showing you that things get more expensive in healthcare costs as you age. If you make it to the average age of 80, you're going to be spending $40,000 a year. If you're fortunate enough to make it to 85 and you're still healthy, you can expect to spend $53,000 a year. If you make it up to 90, I don't want to make it to 90, so let's say 89, $66,000 a year. But let's say you do get that extra year. That's $70,000 a year. So there's other risks that retirees have to face. There's sequence of returns risk. Market losses early in retirement materially increase the probability of portfolio exhaustion. CFP Chad Burton talks about this all the time at our seminars, where the worst years to retire was, 2022. 2022 was awful, especially if you needed your money that year. That's why it's so important to have a 3-year cushion of costs for retirement, as well as an emergency fund while you're younger, kind of similar, so that you don't have to dip into your assets. A lot of guidance can be had by working with a certified financial planner. A severe bear market within the first years of retirement can crush you. It can eat your nest egg. So you got to have that emergency fund. You have to worry about inflation in retirement. Didn't I tell you this is scary? Inflation and rising living costs have forced many to delay retirement or change plans. I wouldn't mind working in retirement, not for the money, but for the social aspects. I already don't have enough male friends. I don't have enough female friends. I really rally around my kids and their sports, as well as my spouse. But I don't have a lot of friends, and that's going to be a problem in retirement. Another big problem with retirees facing is relying on one single income stream. If you're counting on Social Security, you're in trouble. That's not going to cover anything but those healthcare costs that I talked about. Social Security is going to be about $24,000 a month. And healthcare costs start at around $12,000 at age 60. By 65, you're spending up to $16,000. So by age 72, and don't forget Social Security is taxed somewhat, you're spending all of your check on healthcare at $25,000 a year. So don't rely on one income stream, whether it be Social Security or home equity. It'll leave your retirement exposed. There could be policy changes, market shifts, housing corrections. They can materially reduce expected lifetime cash flows. And you also have to worry in retirement about financial pressures. A lot of retirees provide financial support to their adult children or face caregiving costs for aging parents, which often leads to unplanned withdrawals from retirement savings and shorter financial runways. Some tips and tricks that I learned when I was 17, 18 years old was pay yourself first, automate your savings and your investments. The day you're paid, have money go into a 401k. Build an emergency fund, cover 3 to 12 months of expenses, because you're going to get a point in time where you take time off due to health, or maybe a baby, or a car crash, your health. There's a lot of things that will cause you to lose your income. And when you lose that income, you lose your ability to fund your retirement, but more importantly, dip into your savings. You want to track your cash flow, every dollar in and out. Things that I learned when I was younger was prioritize high interest debt. I had some credit card debt come out of college. I paid it off over probably 2 years, maybe 3. And I've never had high credit card debt ever again. In fact, I pay off my credit card balance every month. If you start early with your investing, there's a multiplier. Stocks double every 7.2 years. So 10,000 becomes 20,000 by the time you're 28. By the time you're 35, that 20,000 will become 40,000. By the time you're 42, that 40,000 will become 80,000. And you don't have to ever put more money in at that case. So 10 becomes 20, 20 becomes 40, 40 becomes 80, 80 becomes 160, 160 becomes 320, 320 becomes 640,000, all from that first initial 10,000 in your 20s. Start early. Use dollar cost averaging to reduce market time and risk. I don't try to time the market. It's my time in the market that's important. I keep my eye on broad, low-cost index funds or low-cost ETFs. But then I do have 20 stocks that I have in a portfolio. I rebalance my mutual funds and my ETFs regularly. I sell some of my winners and I buy more of my losers in the world of ETFs. In the world of stocks, I buy more of my winners when they dip and I sell my losers. And I don't look back on them and I don't regret them If you want to talk about your road to retirement, are you doing things right? Are you doing things wrong? Write down my email. It's robblack.com. Let's get you to retirement because I want to do it too. And I'm sharing how I do it with you. Thanks for listening.
You are listening to the Rob Black Show podcast. For more information on EP Wealth, visit robblack.com. That's robblack.com.